Hello and welcome to the BarthCalderon Boss Series. Today we're going to talk about Chief Value Builder. My name is Bill Black. I've been a business planner since 1983. I'm a certified exit planner. I was the founder and host of the Exit Coach radio show and podcast where I interviewed over 1,000 business advisors. And I'm also a speaker with Vistage Worldwide and other organizations. And I'm also a moderator with Vistage Worldwide. This series was developed because we talked to over 5,000 CEOs in different peer groups that we spoke to, and we found that there were certain needs that came to the top over and over again. So we wanted to address those and help our business owner clients and our friends to become better business owners. Today we're going to talk about my role as Chief Value Builder, and if you've been watching the series so far, you know that we've talked about things like changing your role so that you can change and move towards your goal. And today we're going to talk about what creates value, what makes your business sustainable, and what makes your business attractive to a buyer. Let's talk about something called the owner's trap, and this is something we see frequently with business owners. We find a lot of businesses where the business owner does all of the selling and developing of new business. The business owner offers so many different things that they're constantly in a state of modifying and trying to chase around and try to fulfill very difficult changeable orders. The owner is the only one capable of delivering many times the product or service, and the owner interfaces with the customer. We call that the owner's trap, and that's something that you're definitely going to have to work on getting out of if you ever plan to exit your business and create a business that's going to be sellable. So let's talk about that. There are 8 key value drivers we find when we look at business owners. 8 key things that if you get them all lined up in the right direction, your business will be much more sustainable and valuable and sellable. So the first is financial performance and understanding what it is that financial buyers are looking for. Now we find that financial buyers are looking for a couple things. How much profit will your company generate in the future, and how reliable are those estimates? And the better you can show them that you can demonstrate a steady flow of profits, the more valuable your business is going to be. Let's take a look. Typically, businesses are valued based on their future discounted earnings, and a discount rate is applied based on how risky your assumptions are. So if you have a company and the buyer comes in and says, okay, you say you're going to create $1 million of pre-tax profit over the next 10 years, I'm going to discount that by 15%. But if you have a company that is not predictable, that there aren't a lot of processes in place, that it's all about you, the buyer is going to assign a much higher discount rate. Let's see the impact of that higher discount rate at 50%. At 50%, you can see the numbers go down very, very fast. And here's the bottom line on this. At 15% discount, a buyer would look at paying $5,018,000 for this business, generating $1 million of pre-tax profits on a pretty predictable basis. However, at a 50% discount, it only goes down to about $1.965 million. So it's about a 2 times multiple for an unpredictable business versus a 5 times multiple for a 15% discount or a more predictable business. And that's how valuations are typically done, and that's how buyers look at it. So what you need to do is show them there's a very low risk that we're not going to make our numbers. Number 2 is your growth potential. Now when a buyer comes in and looks at your business, they're thinking about, yes, how profitable you're going to be, but they're also looking and seeing what can they do with this business? How can they make it grow? How can it be maybe scaled up under their watch so that they can sell it for a much higher multiple? And we created this grid to help business owners try to figure out how teachable, how valuable, and how repeatable their products and services are, to help them figure out what focus should we have on our products and services. Let's take a look at what a photography company did in this light. They said, well, we like to do weddings. It's teachable. It's very valuable. People pay a lot of money. Problem is it's not repeatable. And so our total score is only 16 in those 3 areas. However, baseball teams might be a good, let's take a look at that. It's teachable. It's easy to teach. It's not very valuable. People won't pay a lot of money for it, but it's very repeatable. It happens at least every once a year, twice a year here in Southern California, maybe 3 times a year. So it's got a little higher score. And they started thinking about corporate events. It's difficult to teach. It's very valuable, and it's pretty repeatable. So there's a score of 18. School photos, however, they take a look at, and they say those are 9s all the way across. It's teachable, it's valuable, and repeatable. So they came up with their top best product or service in their company was school photos. How would that stack up in your company? Take a second and write down the headings for this and take a look. Let's take a look at another company, a CPA firm, and how they would take a look at this. So another way to look at it is to grid it on a monopoly and a teachability scale. Weddings, they're not going to get much of a, they're going to get maybe a monopoly in that area. Maybe they'll own that space. Baseball teams, they're never going to own that space, but it's very teachable. Corporate events, they may get a good reputation there, but it's very difficult to teach. And school photos ended up again in the high spot here. All right, so you can see that the value grid between monopoly and teachability, it's important to find the best balance between those two so that you can have a business that doesn't rely on you to run it, and that it can scale up and you can own your space and potentially charge higher fees for that product or service. Let's take a look at another company, a CPA firm. They offered corporate finance, technology consulting, audits, payroll services, and recording daily deposits. They also reconcile bank accounts and do monthly financial statements, a lot of bookkeeping types of things. They found that they could best get the best bang for their buck there by creating a reputation as a composite or a compilation of various services. So they put up all their teachable and highest value types of situations together, their offerings, into something called the back office support system, where they would pay bills, process payroll, record daily deposits, reconcile bank accounts, and prepare monthly financial statements. So they found that by batching a series of things together, they could get the best reputation and find the most value for their clients. And there's how they batched it all together. Let's take one more example. This was a running shoe store that offered gels, inserts for your running shoes, apparel, and shoes. And they found that by offering clinics, they could get customers to rave about them. And then again, by bringing people into the store and starting clinics and races and race preparation clinics from their store, they could get a lot more people to buy a lot more products and services. So here's the grid. Write those headings down. Product and service. Is it teachable? Is it valuable? And is it repeatable? And find your score. And perhaps you'll find a surprise there when you really check this out with you and your team. Third is your key drivers is the Switzerland structure. Now the Switzerland structure means that you're basically insulated, neutral from the impact of a supplier, a customer, or an employee taking you down. And that means when you're looking around and saying, okay, of my employees, who's holding me captive? Is anybody really holding me captive, or can I replace them easily? How about my suppliers? Is anybody holding me captive, or can I change suppliers? And third is customers. Do I have enough customers so that everything isn't riding on one particular customer or a small group of customers? Those things are very attractive to buyers of businesses, and you need to work on those as an owner to get yourself more neutral to employees, suppliers, and customers. So one way to do that is to rank your employees as in a rank of 1 to, in this case, 26, but however many employees you have. Who's the most difficult to replace, and what are you doing to make them less of an impact on your business if they were to leave? How can you do that? Well, you can have them help you understand exactly what they do and how they do it. They can even write reports on how they do specific tasks if they do them particularly well, so that you have that in a process database so that you can train someone else to do that work if they leave. You can tie them up with non-compete and non-disparagement agreements, and make sure that they won't take, if they leave you, they won't go replace your business, and they won't say bad things about you in the marketplace. There's a lot of ways that you can help your employees be less of an impact. You can do the same with your suppliers and your vendors to figure out how you can perhaps have a more of a bidding war between suppliers and vendors. And again, the third thing you want to check on is your clients. How beholden to any particular client are you, and what can you do to create less of an impact if you lose a client? Fourth in the 8 key value drivers is evaluation teeter-totter. This is all about the fact that when a buyer buys you, they have to write 2 checks. One check is to you, the other check is to the business for working capital. And the better cash flow streams that you've set up in your business by managing it properly, the less they're going to need working capital, and the less working capital they're going to need. Now, basically what you want to do is write down a list of ideas for getting your customers money sooner, and then you want to list ideas for slowing down the speed with which you pay vendors. Can you get people to pay you on a prescription basis or a subscription basis to where they're paying you on a regular basis? Can you get people to pay you annually as opposed to quarterly or monthly? All those are ways to impact your cash flow and, again, get your money in sooner and slow down the speed with which you pay vendors and create more positive cash flow cycles. The 5th driver is recurring revenues. And we find that a lot of companies haven't been paying a lot of attention to this. However, the big companies are. I know I got a printer the other day from HP for the first time in a while, and one of the first things they did was to try to sell me a subscription to have ink delivered to me monthly for a very small price. But again, it got money flowing in. Think of all the millions of printers they sell and the millions of dollars they have in positive cash flow cycles. So the question is, what can you do to create recurring revenue in your business? Maybe it's something you've never even thought of before. Let's talk about 2 different businesses. One is an alarm installation company. The second is also an alarm company, but they don't install, they monitor. Which one do you think is more valuable? Well, it so happens that the installation company, and both of these companies have about a $5 million net revenues, and the installation company is worth on the market about $750,000, while the monitoring company is worth about $2 million. Why? Because the monitoring company has sustainable recurring revenues that can be counted on as they basically take in checks from all their clients every month on a auto withdrawal basis to monitor their services. So even though the installation company does a very important job, the monitoring company is worth almost 4 times what the other company is worth. Let's talk about some of the recurring revenue types of products out there and some examples. One type is consumables like coffee. Well, we all know the Starbucks story. I mean, it's an important place for a lot of people every day. They go there and get their coffee and they drink it and it's gone. They have to go back and get more. Here's another one, sunk money consumables. I have one of these machines in my office. You basically buy the machine and then you have to buy their particular pellets, if you will, or their capsules to fulfill the machine and to make it work. So even though I had put some money in up front, now I'm stuck buying there. Razor blades is another way. Subscriptions or magazines, where basically you pay a subscription and you're going to get something on a monthly basis. This is where a lot of people turn when it comes to intellectual capital like magazines, newsletters, things of that nature, where they get people sucked into buying something on a regular basis, usually for a small amount, and then those people are required to continue to pay on a monthly basis to receive that subscription. Fourth is sunk money subscriptions, where you have a terminal of some kind, as an example, and you need to receive that information. This is more from a corporate standpoint. There's a service called Bloomberg out there. You've probably heard of them. And they put terminals into a lot of the stockbrokers' offices, and to get the information from those terminals, they have to pay a monthly subscription. Second is auto-renewable subscriptions. For instance, think of Iron Mountain. They've built a fortune in renewing revenues by having a place where people warehouse their archived files. And of course, If you want to keep paying, you have to keep paying the auto renewable subscription to have your information warehoused. And the number one, the best, is the long-term contracts like an iPhone. You have a service, you have a product, and to continue to receive the product, you have to pay for the service. There's an example of recurring revenues you can think about as you think about your company and how you can start a recurring revenue stream into the future. Next is the monopoly control. The monopoly control means that of all the businesses out in the world, you do what you do in your niche better than anybody else. This makes you very attractive for a huge strategic buyer, someone that's maybe 10 times your size in your industry, and they just have to have you because you do what you do best. But by creating market differentiate, doing something a little better than everybody else, you create an ability to control pricing in that particular area. So if you're the best in town, you can control your pricing, which you can raise your pricing. That creates higher margins, and then that translates into more money for marketing. It's a great circle of life, basically, and it starts with you starting to think about what can I differentiate and what space can I dominate in the next few years so that I basically am known in that area, and that if a strategic buyer is looking for someone in that area, they're going to think of my company. Here's a grid that you can use to try to figure out the attributes of marketing strategies and how you fit in. Number one is, do I differentiate? How differentiating am I in my services? Not very or very differentiating. And do my customers care about it? Do they care very little or care very much? Again, this is an idea for a grid that you can use to do your own brainstorming so that you can figure out how you differentiate. Here's an example. When Panasonic was looking to enter the laptop space, they knew that Apple was out there in the sexy and kind of owned that area of the market, the sexy part of the market. Dell came along and said, we'll sell direct to the consumer. HP said, we'll be the innovative company. Panasonic thought about it long and hard, and they said, where do we differentiate? We'll have the tough books. And the tough books became the brand of choice in the area where, for the military and the police, where they needed road-tested, very tough laptops. So again, they could have gone with any of the other areas, but they decided to differentiate. They carved out that niche, and they became the product of choice in that niche area. Very smart, something you can think of as you develop your own monopoly control. Number 7 is customer satisfaction. Now, everybody out there is using the same measurement tool for customer satisfaction, has been for the last few years. There's something called the Net Promoter Score. You may have heard of it. I'm sure you've received a survey to help somebody else figure it out. Basically what it is it says on a scale of 1 to 10, how likely are you to recommend our products and services to your friends or colleagues? And basically what you do is you take your number of promoters, those are those that score a 9 or a 10 on that, and your number of passives and your number of detractors. Now your promoters are 9s or 10s, your detractors are your 0 through 3, and your passives are everybody else in the middle. You basically don't care about those for the Net Promoter Score. You're really looking to see what percentage of people are wild about you and will promote you heavily, and you subtract the people who are going to tell people not to buy you. There you have it. That's your Net Promoter Score. In this case, it's 25% minus 5% is 20%. Now let me tell you, when companies are buying you, they may ask, how can you demonstrate your customer satisfaction if you don't know your Net Promoter Score? So this is something to think about, going out and getting your customers to tell you about on a regular basis now. And you can compare yourself to some of the best companies in the world, and they're working continually on their Net Promoter Score to demonstrate. For instance, Apple has a 70+%, Amazon has nearly 70%, Samsung over 50%. The average is somewhere about 15 to 20%. So you can see that knowing your Net Promoter Score and working on that to improve that is going to be very, very attractive to a buyer. And the last driver is hub and spoke. And this is something we talked about right at the beginning. It's how important are you to the overall operations of your business. It's a worthless business has all the customers coming to you, all the employees coming to you, all the suppliers coming to you, and only you make all the decisions, and only you get all the customers. That basically is a worthless business because there's no value if you leave. It was all tied up in you. So you really need to start thinking about how you're going to extract yourself from being the hub. And we talked about that some in our last episode. If you didn't watch that, go back and watch that. But it's very important to understand what you're doing about it. Ask yourself 2 questions. What have you done in the last year to make your business less dependent on you personally? And list 2 specific actions you could take in the next 90 days to make your business less dependent on you personally. That's how you start working on being a successful business owner with something to sell and having the ultimate freedom, the freedom to scale, the freedom to sell, the freedom to pass down your business, or just be the part-time chairman. We offer a free Value Builder assessment if you just go to www.bizgrowth123.com. Again, that's www.bizgrowth123.com, and take the 15-minute assessment at no cost or obligation. You will receive a free report that you can use to grow your business. It'll help you rank yourself in these 8 areas we just talked about. And each area, each chapter has a report to tell you how you can get better in those 8 areas. This Boss series is a series of short videos, articles, and checklists to help you tackle top issues. Next week we're going to talk about I need to cut back the IRS. So please join us for that. And thank you so much for joining us here at BarthCalderon Attorneys, where we believe that planning today for all of your tomorrows is good business. Thank you very much for joining us today, and look forward to the next time.